we're doing a recovery bounce off of what they call the yen carry trade. I had to do a little digging and research into it myself to understand exactly how that plays out. But it's pretty much a forex play. It's a currency play on the Japanese yen and leveraged against the U.S. dollar. So the yen usually pays low to no interest. So what they'll do is they'll buy a certain amount of capital in the yen, and then they'll do pretty much, well, they'll sell a position against the yen and then buy that same amount of shares in the U.S. dollar, which pays 4 or 3 to 4% interest, so 4 or 5% interest. So they're making the money on the difference between the two as far as the interest goes. And then they were leveraging that into higher risk trades, which was crazy to me. That just sounded like a whole debacle waiting to happen. But apparently, if executed properly, it gives you access to more capital and leverage to invest into the market, which I understand them doing. That level of risk seems a little extreme to me, because if something like this, what happened just happened, they're forced to liquidate, which what happened was the value of the Japanese yen started to increase against the value of the dollar at a rapid pace, and that forced a lot of those people who were leveraged against the yen in that yen carry trade to liquidate their positions or put more cash in. And based on the stock market, it looked like a lot of people just liquidated positions to cover their asses. So that's essentially what caused the pullback that we had. There's still going to be some fallout from that, I'm sure. So this is why I'm playing these calls pretty tight, in pretty tight ranges. I'm not looking to trade too heavy. More so looking for entry opportunities for long-term positions. Like Nvidia, anytime it dips below 100, love it there. Microsoft, anytime it gets below 400. But let's see.